Jerome Powell, the chairman of the Federal Reserve, Fed, discussed the impact of higher bond yields on financial conditions during a speech at the Economic Club of New York. He highlighted that the tightening of financial conditions due to elevated bond yields can have significant implications for the Fed's policy decisions. Powell emphasized the cautious approach of the Policy-Setting Committee and its continued attentiveness to the evolving economic landscape. Key quotes from Chairman Powell's speech. Powell mentioned that if there is more evidence of above-trend economic growth or if the labor market stops easing, it could necessitate further tightening of monetary policy. He characterized the current policy stance as restrictive and acknowledged the complexity of balancing between excessive tightening and insufficient tightening, considering various uncertainties. Powell acknowledged the possibility of ongoing tightening in the financial markets. He reiterated the Fed's commitment to achieving a sufficiently restrictive policy stance while closely monitoring data reflecting the resilience of economic growth and labor demand. Powell discussed inflation trends, noting that lower summer inflation readings were favorable, but the data for September was less encouraging. Inflation remained at high levels. He observed that the labor market is tight but gradually cooling. Powell recognized that higher bond yields are contributing to tighter financial conditions, which aligns with the Fed's objectives. He expressed his view that there hasn't been a fundamental shift in how interest rates affect the economy. Powell commented on the market's anticipation of Fed policy changes, suggesting that markets have been reacting ahead of official adjustments. He noted that the neutral interest rate may have increased in the short term, although the longer-term outlook remains unclear. Powell mentioned the possibility of entering a more inflationary period but acknowledged the challenges in making a definitive assessment. He also pointed out that the rise in bond yields does not seem to be driven by expectations of further rate increases. The persistence of this bond yield increase remains uncertain due to market volatility. Market reaction. Following Powell's speech, the benchmark 10-year U.S. Treasury bond yield retreated to the 4.9% range, leading to a weakening of the U.S. dollar against major currencies. The USD index declined by 0.42% on that day, with the euro being the strongest performer against the dollar. Powell's speech had a significant impact on currency markets, with the U.S. dollar losing strength against other major currencies, and it may continue to influence market dynamics in the near term. Market participants are closely monitoring his remarks for clues about the Fed's future policy decisions.
Thanks for watching. Like, comment, share, and subscribe.